At that all day yesterday.
Is there anybody left keeping track this week? I believe we're at 1% on the S&P 500 coming into Friday. We've been all over the place. On the equity market right now, futures slightly negative, down almost 1/10% on the S&P. On the Nasdaq, up a little more than 1/10%. And Amazon, of course, up a whole lot more in the pre-market. There's the opening bell. Get straight to it. Let's get to the bond market. 10-year yields look a little something like this. On 10s, yields higher, 7 basis points to 189.76 on 2s. Yields up 2, approaching 130, going into CPI next week, and we're looking for a 7 handle again. Euro dollar. Euro's seen some strength recently. We erased that coming off the back of the payrolls report. Euro dollar flat now to 114.37. Crude with a lift, $92 a barrel. We had a little look at 93 on Brent, 92.12 right now on WTI, up by more than 2%. So here's your open, 25 seconds in, up a little more than 1/10%. Consumer discretionary up by more than 3%. We'll touch on all of that in just a moment. Energy up by 0.75%. The financials up a little more than 1/10. No doubt the bond market helping their cause. Everything else, at the moment, at least, in negative territory. Want to get straight to one name, the name we've talked about for much of the last 12 hours. Amazon, up by more than 11% in early trading. Joining us from the West Coast, let's get to Ed Ludlow for more. Hey, Ed.
Good morning, John. Look, Amazon has proved that it is greater than the sum of its parts, right? This has been a wild 24 hours in equity markets. I'm sure that some on Global Wall Street would agree. Let's get straight to EBS. This is a profit machine, monster profit, right? We knew about the challenges in the supply chain, labor costs, higher input costs, slowing online sales, but advertising and cloud step up. And that is what boosts the bottom line for Amazon. Yes, okay, they realized a gain on their investment in Rivian, but $27 EPS, I mean, that's just a massive beat. And, you know, it just reinforces in this earnings season, if we bring up the year-to-date performance of these mega caps, just how much of an outlier Meta was, right? Because Amazon has really solidified this idea that the street will go back to these tech names that they favored for a reason over the last 2 years. Look at the earnings projections for full year 22. They're all increased, apart from one name, Meta Platforms. And that chart really says it all, doesn't it, John? Come with me very quickly then into my Bloomberg terminal and look at this chart. Meta trading at a 35% discount to the NASDAQ 100, right? Its lowest relative price to earnings on the NASDAQ 100 ever. A lot of names on the street cut their price targets in the near term, but maintained their bullish outlook. I then go back to Snap. Look at what Snap's trading at now. The narrative around advertising is strong broadly, not with Meta. So there's a lot to unpick here on what went wrong. I still don't think we've quite answered that question. But I ask you, John, is big tech back? Maybe.
Amazon is a fair bit, at least in early trading. Ed, thank you, sir, as always. It's a move of 9.4%. That 9.4% for a stock as large as Amazon is worth $134 billion. Dan Ives of Wedbush says this: multiples will compress, but the underlying growth for the tech space is being underestimated and will thus neutralize some of these perceived Fed tightening headwinds. We can get into this. Anastasia Amoroso, Mike Collins. Anastasia, let's start right here. A $130 billion move in market cap on a single name. Anastasia, what's that about?
Well, it's about a big bifurcation that we see in the tech space right now, and we just see this seesaw every single day. But the reality is we are shaking off the pandemic, and some of the names that have worked so well during the pandemic have seen their multiples and earnings expand. We're not going to see that going forward. Whether you look at Facebook or Peloton or Zoom, what's happened is a huge pull forward in demand because of the pandemic. But now that we're coming out of it, they have to re-engineer for the next phase of growth, and that's going to take some time. So that's why some of those stocks have been beaten up and they've dragged down parts of the market. But I'm very encouraged to see that part of the big tech app trade is still very much on. And whether it's Amazon, whether it's Google, you clearly see that there are parts of tech that are having problems, but there are parts of tech that are very strong and getting stronger. And case in point is cloud computing, for example. As much cloud capacity as we've added today during the pandemic, there's much more to go. And that's what a lot of the chief tech officers are going to be spending on. So you see parts of big tech trade benefit quite a bit from that. And I completely agree with the quote that you showed from Dan, is that, yes, of course, the valuations have to reset to account for Fed tightening policy. But guess what? They already have. If you look at the NASDAQ, we went from 34 times multiple to 26 times multiple on the NASDAQ. And at the same time, we're seeing earnings come through for a big chunk of the technology sector. So I think there's a lot to do within tech on some of these really bumpy and wobbly days.
You're talking about the fundamentals, then. If we can put those single names up on the screen again and just look at some of the performance here. Amazon being one, talked a lot about that, up 9 or 10%. Snap is flying. Snap's a $57 billion company. Now, for a little bit of perspective for you, Barclays is 33 billion sterling. If you saw a move like that in a bank stock, 40%, we'd be wondering what on earth was going on in the world. Anastasia, are we struggling to value these companies day by day? I mean, this is pretty confusing stuff to see these moves this big.
It is, but I think what's happening is there's a bit of a tectonic shift within technology, and there's some older school tech names that are not working as well, and there's competitors that are creeping up on its back. I mean, one big trend for me, John, and I think Facebook and Snap come into this conversation, is this change of perception around social media, centralized social media that collects your data and doesn't give you a whole lot of data privacy. If you look at the crypto community, there's a huge move towards the centralized Web 3.0 that emphasizes user privacy. So I think companies that are aligned with navigating data privacy that is going to be more stringent, and obviously Snap has done a better job of this than Facebook did with the Apple privacy changes. I think those companies that prioritize user privacy, that position for the next trend, which is augmented reality and metaverse, I think those companies are going to continue to differentiate themselves. But there's clearly a changing of the guard that's happening in tech right now.
It's a monster changing of the guard. Snap at the moment up more than 40%. Mike Collins, are you seeing anything like this take place in credit?
Yeah, absolutely, Jonathan, right? I mean, it's like a one variable world, right? It's all about inflation right now and the Fed's reaction function to that and other central banks' reaction function and the impact on real rates and the impact on risk asset valuations. It's all feeding through. They're all pretty correlated. I mean, we've expected to see credit spreads widen here and along with equities valuations coming down as more rate hikes get priced in, as tighter policy gets priced in, right? It's almost a one-to-one relationship, and that has happened in a pretty big way, right? I'm looking at this investment grade corporate index, and it has been widening pretty substantially so far this year, starting last year, right? So the question is, when do you get back in, right? When is the opportunity to add risk, whether it's in investment grade corporates, high yield equities, or maybe even emerging markets, and maybe you need to see inflation indicators start to peak and roll over, which we haven't seen yet, and maybe you need to see the peak hawkishness of these central banks start to ebb, and we're not really that close to that yet, so we're being patient on the credit side.
We might have to wait until Q2, and hold that thought, because I want to come back to you on credit. So we've got Amazon up by 9%. It makes up what of the NASDAQ 100? I think 6 or 7%. There we are, about 7 percentage points of the NASDAQ 100. And we've still got the NASDAQ lower today. On the composite, the NASDAQ down a tenth. On the S&P, we're down 0.2%. Katie Lyons, keep up with this one.
It's very, very difficult to do, John. Of course, Amazon, one of those companies that benefited in a massive way from the pandemic. Due to its other business lines, it's holding up a little bit better. But for a lot of one of those once mighty pandemic trades, they're not doing so well. Peloton, one example, down more than 80% from its record high. Also the likes of Zoom, of Netflix, of PayPal, which reported earlier this week. Just to zero in on PayPal, it fell 30% over just the previous 2 days alone after reporting earnings on Tuesday, after total payment volume for the company rose just 23% in 2021's last quarter, which missed expectations, smallest increase in 2 years. Obviously, the company hurting as the economy opens up and people aren't spending online shopping dollars as much and using PayPal to do that. That has brought the stock back down to earth. And I would note, John, PayPal actually used to trade at near double the forward PE multiple of the NASDAQ 100. They're now roughly in line. But at 25 times for the NASDAQ 100, that is the lowest valuation for that index as a whole, going all the way back to May of 2020. Still, though, that is 30% above the 10-year average. So it goes to show you, John, even as we've seen a lot of these tech names, a lot of these stay-at-home names coming back to earth, they're still really richly valued relative to history.
Kelly, thank you. And for everyone just tuning in, big upside surprise on a payrolls report, 467,000 positive. Big upwards revision as well to the previous month. A lot of details that Mike McKee went through a little bit earlier that's worth paying attention attention to, but big upside surprise and big move in the bond market too. Two-year yields up by 9 basis points, just short of 130 at 129, through 190 on 10s, up 7 basis points. Chris Harvey of Wells Fargo, almost called him Chris Fargo, has this to say: we're getting late in the cycle. The tide will no longer lift all boats and the market will become less and less forgiving in our view. Going forward, we feel investors will need to cut losses quickly and to focus on margins rather than the top or bottom line. Anastasia, can I throw that at you? Margins, they held up really nicely through 2021. Can we repeat the act in 22?
I think it's going to be hard. We certainly should not expect any upside in margins, and I think some industries will fare better than others in terms of preserving their margins. I mean, some of the sectors I'm concerned about in particular are consumer staples and some of the consumer discretionary names, because the margins for those tend to be low to start off with, and also as wages continue to rise, and we just saw a 5.7% increase in wages, those margins are going to compress. And any company where the revenue per employee tends to be very low, I think is quite susceptible from this trend. But if I look within other pockets of the space, and once again I have to steer to software here and parts of technology, margins for that sector are very, very high. For example, for the infotech sector, the margins of 24% are actually double that of the S&P, which is roughly 12%. So that gives you a lot more room to absorb, whether it's higher wages or supply chain disruptions and so forth. So that's why I think on the days like we had yesterday, investors can't help but pivot back to tech and pivot back to software, because once we settle out on the other side of this, and once the Fed moves rates somewhat and the economy slows down somewhat, it's going to be back to the where's the growth that we can count on coming from, and it's going to be from these secular trends that are playing out in tech. And John, if I may just add one more thing. We talked about being more discerning in the market, and I do agree. I think it was Rick who said this, that this is becoming a more narrow market, and we can't just bet on one big beta trade because of the Fed. We have to be more select and find some of those pockets of alpha.
Mike Collins, I'm just getting some response from Scott Minerd over at Guggenheim. He's just sent me a personal email. He's okay with me reading this out. I thought I'd share it with the audience. Here's his view. The Fed will be forced to tighten aggressively just as the economy slows from the lagged effect of stimulus runoff. Risk is increasing that just as the economy is slowing in real terms, the Fed will be fighting inflation. He goes on to say a toxic mix for real growth and financial assets. There is no way out of stagflation at this point. So that's Scott Minerd of Guggenheim. Just sent me that message just now, Mike. I promised to share it with the audience, so I have done. Can you comment on that last line, Mike, from Scott Minerd? There is no way out of stagflation at this point. Your reaction?
Yeah, so that's a world where demand slows and inflation continues to be really high, and it feels like we may move into a version of that world. We actually developed this really cool inflation indicator, Jonathan, where we separated the demand impact on inflation from the supply impact. Interestingly, demand has accounted for actually a little bigger part of the inflation we've seen, right? We had this huge fiscal stimulus, helicopter money, demand for goods surged an incredible amount. No supply chain in the world can keep up with that. But now, as you look at these indicators, the demand side is rolling over, albeit modestly, meaning the growth rate of demand is starting to come down, and the market focuses on second derivatives. And the supply side, believe it or not, and you're seeing a lot of anecdotal evidence in the last just few days, is starting to come back. So that supply and demand is going to meet at some point. The question is when. I would bet maybe by the end of this year, if not probably in the first half of next year, and that means inflation actually starts to roll over and come down. So I'm not a believer that we're stuck in this permanent high inflation world.
I'll revisit that line from Scott Minerd at Guggenheim in just a moment. Anastasia Amoroso, Mike Collins, sticking with us. We're here from the White House a little bit later this hour. We need to talk about crude with them. We need to talk about crude next, hitting a fresh 7-year high.
It's even beyond just Russia-Ukraine. It's also the longer-term ESG initiative. You know, I think as we're turning more green, we're going to have to live with higher oil prices.
That conversation up next.
we've been very clear in our response that if Russia chooses to go into Ukraine, launch another military invasion of Ukraine, it will face severe consequences. It will face economic consequences from the financial sanctions that we and our partners and allies have prepared.
Russia's Foreign Minister Sergei Lavrov brushing off U.S. claims that Moscow is producing a propaganda video. He said the following: I read on the internet that the State Department made some statements that Russia is allegedly preparing a fake video with an apparent attack by Ukrainian soldiers on Donbass. This kind of fantasy is delusional, in my opinion, and there are more and more of them every single day on this situation and what's happening in this commodity market. For more, here's AMH. Anne-Marie.
Hey, John, how are you? Yeah, Mr. Niet there saying he's taking to the internet, realizing what the United States is saying in terms of these potential false flags reports. Now, U.S. officials, Jonathan, have been saying that this is what Russia would do, but now we're getting a little bit more information. They're saying when they are trying to drum up these propaganda videos, they're even using things as corpse, and they're starting to align all of this. There was some pushback from reporters asking for more detailed information, but the State Department saying we will only declassify information when we have some high standards on that we think this is factual and true. So right now, this is where some of the tension is, Jonathan, at the moment. But still, diplomacy does still potentially could be a path forward. We do have Emmanuel Macron heading to Paris on Monday, and those talks will still continue.
Let's talk about that tension in the crude price too, Anne-Marie. That could be a problem. We'll catch up with the White House a little bit later. Good to have you in New York. Thank you. Back with us, Anastasia Omarosa, Mike Collins. Anastasia, you know something about Russia. Let's go there. The situation with Russia, the situation in this commodity market, and what it means to you as an investor at the moment.
Well, the situation in the commodity market, it continues to be a very tight market where demand is picking up strongly and supply is just not coming back fast enough. I mean, clearly the tension with Russia, I think, is adding to some of the upside here. But, you know, it really puts Europe in a predicament because despite all the talk about sanctions and what Europe and U.S. may or may not do towards Russia, there's such a great deal of dependency on Russian natural gas. And given what happened with the EU natural gas market, I don't think they want to see another spike. But if that does happen, if that's where we go and that's where the situation is, then I think that actually does provide potentially more upside for the oil market. If Europe all of a sudden has to switch from using gas and switch to oil as they did earlier last year. So all of that just presents more question marks around demand and supply for the market. I'll also tell you, John, that if you look at OPEC, for example, and what they say they're going to do in terms of supply and what they actually have been doing, there is a big gap that's emerging. And in fact, if you forecast this out some months down the road, there's close to 3 million barrel difference per day that we're going to have in terms of what OPEC said they're going to do and what they're actually doing. So all of that, coupled with very strong demand and some geopolitical uncertainties, I think sets up a very strong crude oil market. Against that backdrop, John, you look at the energy stocks, they've really rallied this year, and maybe they pare back a little bit of those gains, but at these levels of crude oil, energy companies are making a lot of money.
And Mike Collins, they're making a ton of money, and it means a lot to high yield credit, as you know, 93 on Brent, 92 on WTI. You've run us through the strategy around treasuries. Short the front end, you'd be a buyer of the long end, maybe at around 190 on 10s. Where are you left in credit with energy doing what it's doing right now, Mike?
Yeah, I mean, the energy sector still has been one of our bigger overweights. Not that we predicted oil prices go to 92, Jonathan, but we did expect the fundamentals to continue to improve, cash flows to continue to improve, leverage coming down, and that's all happening in a really big way. So that's definitely supportive of their equities, of their credit. On the bigger picture, it's really interesting, Jonathan. Right? Normally, geopolitical risk is like a risk-off environment. It means, you know, growth slows, maybe central banks pause on their rate hikes, but in this case, it's adding to the inflation. Not to keep harping on inflation, Jonathan, but it's so important. Inflation is such a hugely regressive tax around the world, especially in Europe, where it has really hit hard. So these central banks have to fight inflation even in the face of this demand slowing and these big geopolitical risks, which is a really risky environment.
And can I go back to that line then from Scott Miner to Guggenheim, and Anastasia, give you the opportunity to respond to it. I'll go through that quote again. The Fed will be forced to tighten aggressively just as the economy slows from the lagged effect of stimulus and that runoff. The risk is increasing that just as the economy is slowing in real terms, the Fed will be fighting inflation. There is no way out of stagflation at this point. Scott Miner to me over email just moments ago. Anastasia, the final word on that, the risk of the S word.
John, I would respectfully take the other side of that. And I say this for a couple of reasons. I don't think the Fed is really trying to hike to slow down the 7% headline inflation because they can't. That is not driven by demand. It is driven by supply. The Fed cannot fix the pandemic. They cannot fix the absences. They cannot fix the shortages. They cannot fix the port congestions. The governments, the administration, the governors have to fix all that by making sure that we get out of this pandemic and we get back to normal. So that's what eventually I think is going to happen. So the Fed is not going to hike for 7%. I think the Fed is going to hike to slow down inflation that we're seeing in the labor market, for example, and perhaps in the housing market. So if that necessitates 4 or 5 rate hikes and maybe another 3 or 4 next year, guess what? The real interest rates are still going to be below zero, slightly below zero where we are today. So yes, the Fed is tightening and they have many ways to do this, but I still think we're not nearly close to the level of neutral on interest rates in the economy. We're not going to be there most likely next year. So they're not really over tightening in real terms just yet.
Anastasia Amoroso. Anastasia, thank you. Thank you very much. Alongside Mike Collins, their reaction to the jobs market, the economic data and what's happening in this market right now. A massive upside surprise on payrolls, 467,000. The estimate, 125K. Joining us now, I'm pleased to say, Marty Walsh, the US Secretary of Labor. Secretary Walsh, this is not the conversation that maybe you were preparing for yesterday or I was preparing for overnight. Can we just recall what you said earlier this week going into this number? Let's listen into that together.
We're living in very interesting, unique times. This is unlike anything that any White House has ever experienced before, well, maybe 100 years ago. So we're going to continue to follow the president as he continues to put plans out there to move our economy forward and moving people forward.
You were preparing us for a soft print, Secretary Walsh. We got a mega one, a fantastic one, 467,000. There's some interesting details beneath the surface. Just give me your take first of all, please.
Well, first and foremost, just for the clip, just to stay in line here, we are still living in very unique, interesting times, in the first in a century pandemic. But we look at these reports. Let me just touch on this two ways. Number one, the report for the month of January was a very good report, a very solid report, and I think underlying what it's telling us is that we're in a very different position than we were in March, April, May, June of 2020. We're seeing people and economies and workplaces and workers and employers really learning to live with the pandemic and adjust. So we are in a different place there, number one. The adjustments certainly is great to see too. BLS is the gold standard when it comes to taking in numbers. We all know that in this country, and they're very transparent. And when I saw that number today, that was actually more surprising to me a little bit than the month of January. And I asked them, how did we revise 700,000+ jobs? And what was explained to me was over the last 10 years, we've had about the same revisions over that same period of time. So we're excited. I'm excited today, but something, we still have work to do. And this celebration can last for a little bit, a couple hours while I do these TV hits. Yeah. And then we got to go back to work.
Well, let's talk about what we've got to work on. The consumer at the moment, Secretary Walsh, just doesn't feel it. I can go through the data. Yeah. I can talk about where unemployment is, where wages are. They feel the 7% inflation. They feel crude prices where they are. Crude through the 90s at 92. You saw consumer sentiment last week, decade low. What's the disconnect there at the moment for you, Secretary Walsh, and how do you and the administration fix that? How you say things are and how they look and how people feel at the moment?
Yeah, I don't know if it's necessarily a disconnect. I think it really is about how people feel at the moment. The American people and folks in this world have gone through a lot in the last 2 years with the pandemic, and I think there's a lot of concern about their family, a lot of concern about the virus, a lot of concern about if you've been vaccinated, the people that aren't vaccinated, if you're not vaccinated, you don't want to get vaccinated. So there's a lot of concern there. But all I know is that the president laid out a plan at the beginning of last year to get people back to work. 6.7 million Americans got back to work. The president laid out a plan to deal with inflation a little bit into 2021. We're working on those supply chain issues and other things. So we just need to continue to do our job. I think that you worry about the poll numbers later on, but right now you worry about doing your job. And as a former elected official, obviously you want to see the great numbers and you feel good about it. But at the end of the day, you still have to do your job. And the president is very focused on making sure he does everything for the American people, including not just bringing down inflation, but also bringing up wages.
Well, let's talk about the inflation side of it. sneak peek of next week for you. 7.3% the median estimate, the high 7.6, the low 7. Going through some of the estimates, Lloyds Bank at 7.6, Credit Suisse at 7.4, Morgan Stanley at 7.3. Caught up with Ellen Zetter of Morgan Stanley. They're looking for a punchy number next week. Secretary Walsh, what's the message going to be from the administration as we just keep seeing inflation kick higher and stay at these levels?
From where I sit, my job is to make sure that we continue to get people back to work. And, you know, I had a meeting with Secretary Yellen earlier this week. We talked a little bit about inflation. We talked about the job market. We talked about creating opportunities for people. We talked about the infrastructure law that was passed and the investments that are going to be made there. So I'm going to continue to do my job, and different parts of the administration are going to be working on the inflation side. I'm part of that as well with the supply chain. But you know, again, we're taking this a day at a time.
What does that mean when you say we're going to help people get back to work? What specifically are you in the administration doing to try and achieve that?
Well, certainly I'm working with governors and mayors across the country. We're making investments in job training programs. We're looking at the way we do job training and workforce development. In the infrastructure law, we're making sure that we're going to be working on pre-apprenticeship programs and apprenticeship programs to get more people into the building trades. We're going to be working on the supply chain. We're working on the trucking industry to get more people in the trucking side of supply chain demands that are happening in our country now. Last mile, you know, a lot of the concerns we have is not just bringing ships in off the coast to unload them. We also need to make sure the products that are on those ships get to stores, get to warehouses, get to Main Street America. So we're working to increase other jobs. We also saw one of the participation rates that we saw in that's growing is younger people, 16 to 21, people getting into the workforce. We need to make sure that as those folks get into the workforce, that we're training them not just for the jobs of today, but making sure they have really pathways into the middle class. So that's what I mean by that.
Secretary Walsh, just a final question from me, and allow me to go here. The Bank of England governor, Mr. Bailey, yesterday faced a lot of backlash for what he said about pay rises and workers, and he effectively said that the people in the UK shouldn't demand a big pay rise this year because it might cause more problems. I just wonder, as a union guy yourself, how you'd respond to a line like that, what your position would be on that debate at the moment.
I think any time that we see increases in wages for people, that's a good thing. We saw roughly 13 to 15% wage increase in hospitality. And what did we see? We saw more participation of workers in that industry. I think it's important to pay workers more. It's important to respect our workers. And it's important to keep our economy moving forward.
Marty Walsh, the US Secretary of Labour. Marty, thank you. I know you're super busy trying to explain this one to a lot of people after setting us up maybe for a soft print. We got a really, really good print. Secretary Walsh there, thank you very much. From New York City this morning, I want to whip through the price action for you very briefly. 30 minutes into the session, we look a little like this on the equity market. 0.2% higher on the S&P. On the Nasdaq, up about 6 or 7/10 of 1%. Looking at the FTSE, we're down, and in Europe we're down even harder. We're negative 1.7% on the equity benchmark in Frankfurt, Germany. Over in Europe, just away from the US for a moment, yes, we've got to move here on twos in America, up 10 basis points to 130 almost. Look to Italy, there's some real tension here that I know Guy Johnson's going to pick up on briefly, up 10 basis points on an Italian 2-year to 0.27. That yield was in negative territory a little bit earlier. From New York, I'll leave you with that. I'll catch up with you a little bit later on Bloomberg Real Yield. From New York City, good morning to you all. This is Bloomberg.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Friday, February 4th. Here are the top market stories we are following for you at this hour. A massive jobs surprise. The January jobs report blows estimates out of the water with 467,000 additions plus an upward revision for December. Wages up, participation up, bond yields go up too. What does it mean for the Federal Reserve? Amazon amazes. The company posts a blowout profit thanks to the cloud and advertising, plus raises the cost of Prime, sending shares surging toward one of the largest, biggest one-day market cap gains in history. And what a week again. The best four-day streak for stocks since November 2020, followed by the biggest one-day drop for the NASDAQ since September of 2020. It's been another volatile ride for equity investors, and the week is not over yet. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. Guy, happy Friday. This week felt like a long one, and more excitement this morning.
Yeah, it's as it was yesterday at this time, Kaylee. We're in a situation where I don't know where to look. There are so many big stories. The macro story is absolutely front and center, but then you kind of fold in what's happened with Amazon and think about what's going on there, that huge gain we're seeing. I think you probably need to look at that over a few days really to get the real picture. You've seen really choppy trading in Amazon this week, but the payroll number obviously is a huge figure that we need to focus on. I think you're right to focus on the revisions. I think that is an area that we need to explore a little bit more, what's happening with the BLS data. I know the Labour Secretary addressed that. And then you've got to think about what is happening over here in Europe as well. The handbrake turn that both Christine Lagarde and the Governor of the Bank of England, Andrew Bailey, delivered yesterday, absolutely eye-watering, and the effect in terms of the rates market continues to be felt. Italy up sharply, Greece up sharply. The story goes on and on and on. It has been a story really of a macro mess, a top-down story that we're kind of trying to figure out this week, and a bottom-up earnings story which we're trying to factor in and fold into that story. But the number of the day is definitely 467,000. That is the number that we got delivered on our Bloomberg terminals. The payroll number blowing past all expectations. Even the Labour Secretary sounding a little bit surprised just a few moments ago talking to John Ferro. So that brings us to the question of the day. Where does this leave us? Plus the revisions. Does that blowout number put 50 basis points back on the table? Well, let's talk about that. Betsy Stevenson, University of Michigan Professor of Public Policy and Economics, a former Labour Department Chief Economist under President Obama, joining us. And of course, Bloomberg's Mike McKee. Betsy, let me start with you. And I want to go straight to the question of the day. Is this a number that you think the Fed needs to react more aggressively? How would you characterize the labor market at the moment? Is it strong enough to justify a 50 basis point hike from the Federal Reserve?
You know, I actually don't think there is that much news in this report. And I know that's a very funny thing to say given what a large surprise it was. But what it shows is that the economy is strong and has been strong. And Omicron didn't get in the way of jobs in terms of people either losing jobs or disappearing for an entire pay period. That doesn't mean that they were all producing at their top capacity for the month of January. What it means is employers were in the process of hiring people. They didn't stop that because people got sick for a little bit. They didn't let people go because people got sick. And even if they had a few slow days at their business, they didn't shut their doors. So we see that the labor market's healing. And in fact, if you look overall at this report, what you saw was we've had a more steady healing of the labor market over the last 12 months than we had thought. You know, we thought we had this great June, July, and then it was weaker at the end of the year. And what the BLS said is, sorry, actually, it looks like it was a little bit more steady throughout the year, sort of healing consistently.
All right, Mike McKee, I heard you laughing pretty hard when the number dropped at 8:30 a.m. Eastern time. I think it all took us a minute to digest what we were seeing. Do you think it wasn't ultimately that much of a surprise today?
Yeah, I agree with Betsy. it isn't going to be a surprise for the Fed, and it isn't going to change the way the Fed is thinking about it, because the way Wall Street has reacted, the number to people trading has been the change from December to January, but the change isn't comparable because, as Betsy was just saying, they did a lot of revisions to 2021 data, and what it's telling us is the job market was a little bit stronger in 2021 than we thought, but not all that much, but the numbers get revised up a little bit. And that's the problem here, is the Fed knows now that it had a stronger economy than it even thought, but it doesn't necessarily mean that it has picked up or that we're going to see a big inflation surge out of it. The numbers in terms of average hourly earnings, when you look at the breakdown, a lot of that was in the construction field, manufacturing, and some of the higher paid jobs, and the people in the leisure and hospitality sector only gained 1 cent on the month, even though 151,000 people were added into that jobs category. So they're going to have to do a lot of deconstructing of the revisions to this and figure out exactly how it does affect things going forward. It's kind of hard to tell.
Okay, Mike, I take on board what you're saying about the complexity of these numbers, and they are complex. The bond market is moving higher in terms of the yield. The US 10-year now 1.9. We've moved beyond that. As you can see, a significant, well, a two-step higher. We get the CPI report next Thursday. If you put this labor market report next to a, let's call it a 7% plus print come next Thursday, where do you think that will leave the Fed? With the market moving higher, do you think this is something that's going to be increasingly hard for the Fed to resist? I saw the ECB have to react yesterday to market expectations, the data coming in significantly stronger than anticipated. Are we going to have to see another revision from the Fed in terms of its approach?
Well, not based on what we know now. I mean, the Fed has basically set its course based on that 7% CPI and the 5.3 or whatever it is, the PCE number. So they're not going to be changing unless we get a significantly higher inflation print over the next 2 months. And we will get 2 months worth of inflation data before the Fed has to make a decision. And let's see what happens with the jobs numbers next month, because they tend to revert to a mean. The mean's a little bit higher. Things are getting stronger, but it may not be as strong as it looks to the bond market right now.
Betsy, we were hearing from the Labor Secretary just a few minutes ago. He talked about wanting to get wages up and yet inflation down. I'm wondering how you look at this wage growth data in the prospect of higher inflation more broadly.
Yeah, so the risk to higher inflation in 2022 or continued high inflation in 2022 is not being able to hire people in the service sector as demand for services returns. So people with Omicron fading, they're going to want to get out to restaurants. They're going to want to get out to entertainment. Hiring in the service sector is what has lagged in this economy, right? We've gotten everybody back in the goods sector. Demand for goods is skyrocketed. It's demand for services that's lagged, and it's employment and services that's lagged. What we saw in this jobs report is almost all those jobs were added in the service sector. We didn't see a lot of upward wage pressure necessary to get those folks back. So for me, that looks like, look, the good news is people are going to come back to those jobs. Yes, we want to see higher wages, but we want to see higher wages coming out of higher productivity. We want to see us being able to get people back to services without just having to push the prices up. And I think that this report indicated, at least for now, we're pulling people back into the service sector without enormous upward pressure in prices.
Betsy, will that pressure come? It was interesting. We saw the participation rate for 55 and up in terms of the age cohort. The pickup we saw in this data was the largest rise since 2003. Are we starting to pull people back in that had thought about taking time out of the labor market, reconsidering their options, maybe retiring? Are we starting to see some of those people coming back into the labor market? And do you think that is a trend that is going to persist?
Well, I think we're going to need to spend some time digesting what's going on in the labor market for people over the age of 55. Look, there's some bad news that the census released, which was there are fewer older people out there than we thought. More of them had died. And because they're dead, they're no longer in the denominator. And that means that we've seen a higher labor force participation rate and higher employment rate of living people over the age of 55 than we thought we were seeing over the last year. So I think that does raise some questions about how much higher we can get that labor force participation rate of people over 55. I will say that was actually, I think, one of the saddest or worst parts of the report for me, because I think there is less slack in that older age group than I had previously thought before I saw these numbers today.
So obviously the higher participation rate probably going to catch the eye of the Federal Reserve, Mike, as will the wage number, as will all of it. Is there anything within this data, if it doesn't necessarily mean that the Fed is going to tilt in a more hawkish direction, that would indicate that they don't have to move as aggressively as the market is priced for?
Well, that depends on what the market is priced for when we get closer to the meeting. The Fed's going to ignore kind of what's happening with Fed funds futures or overnight index swaps until they get a lot more data. And we get another payrolls report, the February payrolls report. We get 2 CPI reports. We get another PCE inflation number report. Plus, we'll get all kinds of tertiary data that will give them a better idea of where the economy actually is. This report full of statistical revisions, both the benchmark changes and the seasonal adjustments that they make. They said they have improved the seasonals. So the Fed is going to have to look through this and wait. I mean, you talked about the participation rate went up by 0.3, yes, but that was because of the benchmark revisions, not because it went up 0.3 in 1 month. It was 62 last month. And so at this point, the Fed kind of has to wait.
Betsy, one final quick question from me. I'm trying to bring together the ECB, the Bank of England, the Fed, and what the message is from all of them, and maybe there isn't a consistent message. But what I've been hearing over the last few days, the implicit message seems to be that the potential of these economies isn't as great as we first thought coming out of this crisis, and as a result of which we can't drive them as fast, we can't drive the car as fast without it shaking. Is that what central banks are telling us at the moment? Is that the underlying message here?
Oh, I mean, I guess I'm more of an optimist than you, so I think the underlying message is hooray for the central banks. Boy, did they get us back quick coming out of an unprecedented or as Marty Walsh said, in the last 100 years, unprecedented pandemic. So I think they've done an incredible job. It is obviously the case that we lost some of our potential. The COVID cost was real. We're still actually paying it. We've had to dedicate resources towards fighting a contagious disease that could be used to produce goods and services we want that are not related to a contagious disease if we didn't have one. So we've clearly lost potential. But I don't think that the message here is that they've been driving the car too fast. In fact, I think it's that they really did the right thing for getting an economy to heal very quickly.
Yep, we're almost back to where we were. But a lot of demand has come through as a result. Betsy, I'm glad to hear your glass half full. Thank you very much indeed for joining us today. We really appreciate your time. Love an optimist. Betsy Stevenson of the University of Michigan. And of course, our thanks to Bloomberg's Mike McKee. What are we going to be doing next? We've talked about the blowout jobs numbers. Now let's talk about another blowout number, Amazon. Incredible fourth quarter results. We'll dig into the week that was for big tech next. This is Bloomberg. What I'm about to read may be something of an understatement. It has been a volatile week for tech stocks. You can look for some massive swings on the charts. There are many of them. That's the Nasdaq you can see on the screen in front of you. Over the last 5 days, it is up by 1.45%. But we've seen what's happened with Snap overnight, with Amazon overnight. We've seen what's happened this week with Meta and the huge swings we've seen there. PayPal, another one. Let's talk about it, trying to bring it together and understand what has happened here. Ed Ludlow joins us now from San Francisco. Ed, I want to talk in a moment more about the details surrounding Amazon, but let's just kind of start with the big picture. Has it been a good week for big tech?
It's been a rough week. It's been a wild week. You know, I think we started the week by asking, or we asked after the Meta earnings, is the rally in tech stocks over? And if there's one lesson of this earnings season, it's not to take one trading session in isolation, not to take one company's earnings in isolation. The reason I say that, it's become pretty clear overnight that Meta was the outlier. Look at the other mega caps and what Wall Street has done subsequently, and they have raised earnings expectations for full year 22. They've raised their earnings forecasts, and they see strength and staying power because the companies that did well, excluding Meta, were able to navigate what frankly were a very difficult set of circumstances, and they grew parts of their business where there were concerns that growth would slow.
Well, and it speaks to as well, Meta versus everyone else, when you look at some of these other social media-oriented stocks, the likes of Snap and Pinterest that reported overnight, blew it out of the water. Snap up more than 40% today. Is this all just an idiosyncratic Meta story as opposed to other technology platforms?
It's a really good point. I mean, I was shocked by Snap. You know, the Snap market reaction after hours and in today's session has been pretty strong, but I went back and read the transcript of the earnings call, and they were pretty candid that the use of their platform has not returned to pre-pandemic levels. They've grown their user base, but what has attracted that new user base is premium content. And you know, it's kind of a case of reading between the lines. There was ad strength in Alphabet and Google, direct search ads. There was ad strength with Amazon, which broke it out as a line item for the first time. Ad strength with Snap. I asked the question, and we'll ask our guests this all day long, did people move dollars, ad dollars, away from Meta and Facebook and to those platforms because they were less susceptible to the Apple iOS changes? That's a big question.
Yeah, I get it feels like in some ways it maybe was a zero-sum game. Ed, let's talk a little bit about Amazon in detail. The move is, I think you need to take the move in context of the week. It's been an incredibly choppy week for Amazon, and the stock sold off quite hard going into the close last night. I think people were just nervous going into the number. But let's talk about what the market has reacted to here. I struggle with the idea that the market is reacting to an increase in the cost of Prime because, yes, that goes straight to the bottom line. Nevertheless, it's going to have an impact, but not a big impact. What really struck me overnight was AWS, which continues to go from strength to strength, but they're breaking out the advertising numbers now. And it feels like Amazon is now also an ad company. To your previous point, they seem to be doing well with it. So my question is, what is the market reacting to here?
I think if we could sum up the market reaction and also the analysis of the sell side that we've been reading this morning, it's that Amazon has proved that it's greater than the sum of its parts, right? Profitability came from the cloud unit in advertising at a time where they gave a pretty conservative or cool outlook around the online business and e-commerce. The online business and e-commerce was coming from a very high bar of that period of 2020, right, where the pandemic was at its depths. We saw such pull forward in the growth of e-commerce, but now we're seeing on a year-on-year basis those online sales slow. No problem, because the big driver of profit is growing at such a clip, advertising and cloud. In the moment last night, the stocks soared on the price raise of Prime. You know, and so your question is really interesting, but I think that the street basically took confidence in Amazon's confidence to do that. And on the call, executives did stress, we don't think this is going to result in cancellations, not at all.
All right, Bloomberg's Ed Ludlow. Busy week for Ed, busy week for all of us. Thank you so much for joining us from San Francisco. It's also been a busy week for Kruti Gupta, who is trying to sort through all of this market noise, track it through ETFs for this ETF Friday. Kruti, what are you looking at?
Yeah, Kaylee, we just got to talk about this tech trade, right? Because it was a monster week. But let's just go through the ETF flows, especially today when you have kind of a tug of war in terms of the Amazon of it all and the bullish side, but then the likes of Apple, which are actually a weight on the index. So once again, a tug of war on the index level. On the ETF level, people seem pretty bullish tech. So right here, I'm going to start in the middle of the pack. Your internet ETFs are actually seeing quite a bit of inflows. You're also seeing them really gain today. You are also seeing that high beta tech play. So your classic Cathie Wood ARK Innovation ETF actually up to the tune of 4%. Remember, as tech outperforms, biotech outperforms as well. The downside, though, is going to be those home builders. So this is coming in line with some of that pressure you're seeing on materials, on industrial stocks as well. But while we're talking about commodities, I should really just have started with that USO, which of course is rallying in line with oil prices. Brent hitting over $93 a barrel. Well, let's just go back to tech here because it's those weekly inflows that are really catching my attention. I mean, it's been 4 straight days or 4 straight sessions of positive tech gains in the NASDAQ, but then you had this big underperformance in Meta. I should mention, as you had Meta Platforms under pressure yesterday, retail hopped into that trade. And you can really see that show up in the weekly flows here for the QQQ ETF. Take a look at this. It's positive on the week, which tells you that as you start to see some of these kind of questions of do you not invest in tech? Is this the bottom? Well, on the ETF world, it seems like people are pretty bullish.
Kruti, let's talk about what's happening in bond land. The US 30-year is now up by 7 basis points, 222. I've got a US 10-year up 8.5 basis points, got a 1.9 handle there. Huge moves in Europe as well. BTPs, Greek bond market, UK bond market, all reacting to the news we've had from the Bank of England and the ECB. Talk me through what the flow action looks like around that from an ETF point of view.
Yeah, Guy, as if the Fed wasn't hawkish enough, now it's really getting an extra boost from its European peers as well. And it's showing up in the bond market pretty interestingly. Now you're kind of seeing that sell-off in treasuries, those yields starting to creep up higher. In the ETF space, a similar story. TLT and TIP, which of course are your classic treasury and TIPS plays, those are of course going to see your most outflows. But towards the bottom of the pack is LQD. That's our investment grade ETF. You're seeing a less aggressive impact in those bonds. But I really want to point to the highlight here for me, which is of course the HYG fund. It tracks the high yield market. Think about $2.4 billion exit. But remember, that's coming in the face of higher oil prices. We know that the high yield index, well, about 12% are those energy bonds. So even in the face of it, you do see that tug of war between what is the Fed going to do versus is this a good thing for energy prices, which continue to rise and rise.
Great stuff, Kruti. Great analysis. Thank you very much indeed. Always appreciate it. Kruti Gupta working our way through the ETF story as we come through Friday. Kaylee, I'm just, the numbers on the screen, I don't know which way to look again. I keep coming back to this as this kind of problem. I'm trying to watch the equity markets and see what is happening, but the moves in the bond market this afternoon are absolutely blistering over here in Europe, and you're mourning over there as well. Like the US 10-year, 1.921.
Yeah, and that's being driven, importantly, Guy, by higher real yields. It's not a move in break-evens. The 10-year real yield now at just negative 48 basis points, less than negative half of 1%, Guy. Something to watch and definitely has implications for this equity market.
More on the jobs market next. This is Bloomberg.
It's been an hour since the start of the U.S. trading session, and back for an encore now. Kriti Gupta helping us take a look at the market moves. Kriti, long time no see.
Yeah, it's been a while, right? Let's just talk about the stock market because it's been a while. We've seen some clear direction here too. The S&P 500 in the pre-market, you had a very clearly bearish tone, and they're really all getting turned around by the jobs report. Is that hawkish for the Fed? Is that dovish for the Fed? The idea that you are actually seeing a pretty big positive upside surprise, does that reinforce the